Good morning, all. I request Shiva Prasad sir to introduce today's speaker.
Good morning, all. A warm welcome to this session on key drivers in evaluation for fundraising. I'm privileged to introduce Mr. Rohit Gupta, who is a chartered accountant and evaluator. Mr. Rohit is a seasoned finance professional with over 12 years of experience in financial consulting, specializing in virtual CFO services, fundraising, and strategic financial management. A chartered accountant and company secretary, he is the managing partner at Ashwasan Advisors LLP, where he leads financial advisory and governance practices. Mr. Rohit has worked with leading global firms such as E&Y, Deloitte, and Godrej, as well as high growth startups like Volopay and Masai, gaining rich experience in cross border financial planning and risk management. His sector expertise spans iron and steel, power, aluminum, retail, fintech, edtech, and SaaS. Known for his strong execution in driving financial growth and ensuring compliance, Mr. Rohit is a trusted advisor to both emerging startups and established enterprises. We may recall in this occasion that Mr. Rohit has taken one session in our Coimbatore event held last year, and we would like to have his sessions in the future um, for some more times. And Mr. Rohit will be covering the subtopics such as understanding valuation. One minute. Key valuation drivers, qualitative and fundraising life cycle. As you know, that say we as valuers have got a vital role in advising our customers, our clients regarding the intricacies involved in the valuation for fundraising. So I am sure that this session will be very much useful for all of us. And Mr. Rohit will enlighten us with his knowledge, rich knowledge gained in his past 15 years, 12 years of experience, and in other areas also. Thank you. And again, I extend my warm welcome to Mr. Rohit and as well as other participants who have joined today. And I'm hopeful that the same many more will join soon. Now it is to you, Mr. Rohit. Please take over.
Thank you, Mr. Shiva. Thank you for such a warm welcome, and I welcome everyone from the Bangalore Valuers Association and other participants to this session. So, regarding valuation drivers, key valuation drivers for fundraising in today's environment, I want to make this session a little interactive, and I would like everyone of you to participate here so that I think it's a pretty interesting topic in today's era as well. And you all being valuers and professionals in your professional experts in your respective fields, it is important that we interact a lot on this session through chat box and go how it is. So, Vijaya, can I share my screen from here?
Yes, sir. Please share your screen, sir.
Just a second. Let me just. Hmm. Uh, uh, I don't know. I'm not able to share. Vijay, I'm sharing the document with you. Can you please just share?
Yes, sir. Please, sir.
Just check which I've sent it to you on our WhatsApp. If you could just.
One second, sir. It is opening.
Yeah, sure.
I hope the screen is visible.
Yeah. Okay. So, good morning, everyone. And thank you for having me here to have a pretty discussion on this topic, key drivers in valuation for fundraising. And uh, I hope to it to be a very interactive session. So before I start the session and start going deep into this topic, I would like to ask each one of you, what do you understand uh, by the term value? Not valuation, but value. So I request everyone to take part through chat box so that we can move ahead. What is value? What do you understand by the term value in a company or value in anything? Okay, how much worth it is? Pretty fair. Perceived intrinsic worth, nice. An amount a buyer is willing to pay, very nice.
జాగ్రత్త
Relative to time, okay. Nice. Anyone else, or shall we proceed? The utility a buyer sees in the product in monetary terms, very nice. Thank you, Siva sir, for this definition. Okay, so thank you everyone for participating in defining the value. So as we move ahead, we'll understand more about the value, but let me give you my perspective of the value. So value, I believe, something which is a combination of a founder's perspective, a founder's um, intention to grow, and an investor or the buyer's what you say or investor's confidence on the buyer or on the seller actually. So when we talk about valuation, so valuation comes from a combination of a buyer's, not only buyers, but a founder's conviction towards the idea, a founder's education or background in the particular field, plus the value he is bringing with the help of the product or service he's offering, plus how investor sees that overall thing in one bucket taken together. So that is what a valuation or a value is. So that is what a value is meant when we're talking about valuation for fundraising. So let's move ahead and understand the key drivers. And I would love everyone to interact as we just did. Thank you. So can you move to the next slide, Vijay? Okay. So I've divided this slide into a few parts. So we will talk about what is valuation, what is the core objective of valuation, how deals are affected or perceived by investors, what is the realism of the company's growth story, which is impacted by valuation. And this presentation aims to demystify valuation drivers, which would essentially mean that we are going to understand valuation drivers that can help entrepreneurs secure a better terms. Vijay, next slide, please. Yeah. When a founder wants to raise money and he approaches any investor, the investor not only looks at how much money he wants to raise or the kind of product he's launching. So it depends on a lot of other factors as well, which I've tried to break down and summarize in four kind of drivers, which generally in a global environment, an investor is looking for. So one would be the qualitative drivers, which would include the quality of the founders, the brand strength, and defensibility against competition. So it's all qualitative factors which will be dependent on the macroeconomic factor, the market you're working in, and the quality of the product you're trying to bring in. Then we have quantitative factors. So quantitative factors would emphasize on measurable financial metrics such as revenue, profit margins, and available runway. So that is basically talk about money, right? So quantitative factors would define how much money would be raised based on a particular valuation which will be arrived with a combination of all those factors. Then we have market-based drivers. So once the qualitative and quantitative, appraisal is done, they definitely would want to understand whether the funds you're raising for a product or service you're offering has a market pull, right? Or you need to push it to the market, right? So generally, if you have a product which has a market pull, it will demand for a higher valuation, very good valuation. But if something is something you're creating needs to be pushed to the market, right? Obviously, the investor won't be interested into it, right? Because if you need to push something, that's never going to grow. And then last but not least, the future potential of the product, right? So which would assess the scalability of the business, the strength of the pipeline, and the clarity of the roadmap for growth. So these are the four categories of valuation drivers which we would be covering in detail in the next coming 35 to 40 minutes. And then we'll have a few case studies which have been curated specifically for this session to understand how a mixture or combination of these factors have actually resulted into good valuations or bad valuations for founders to raise the money. Can we move to the next slide, Vijay? Yeah. So, as I said, qualitative factor is something which defines quality. So, quality in founding team, quality in product market fit, quality in brand, or quality in defensibility. People often ask me, why do you investor put some money in a company which is still at idea stage? I mean, the product has not been launched, the the go-to-market strategy is not finalized. They don't know whether that product will work or not. So I always say there's a saying, you don't put money on the horses, but you put money on the jockey, right? So there's a saying. So that means that most of the investors, they want to place their bet on the founders and not only on the product, right? And that is why when we are talking about qualitative drivers in evaluation, the founding team or the people running the show comes in number one, right? So investors back people, teams with complementary experience, education and startup background or successful exits command better trust and higher valuation. So if we talk about two kind of examples, right? So I'll talk about the most um what you say most heard startup nowadays, Zepto, which we all are using in our day-to-day life. The founder, Adit Pachila, happens to be a Harvard dropout, and he started this startup at the age of 19. Now people might ask what kind of credibility he had at 19 years of age that he was able to raise such kind of funds. Well, first, if he has gone to Harvard on merit, that shows that he was quite intelligent. He went to one of the finest colleges of the world. He started early, so people would have more conviction on the founders who take risk at early stage. Next, the most important part, which a lot of people don't know, Adit's father was a well-connected person in a venture fund and hedge fund industry, which actually helped him in getting connected to investors. Next, uh, have you heard of Zoho, right? So how big the Zoho has become, right? Mr. Bamboo, Sridhar Bamboo. Now, he never raised money. He never raised money. His company was totally bootstrapped. So, does that also mean that you may not need to raise funds even if your valuation is good or even if your product is good? Yes, definitely. So, raising money is not everything, right? But yes, your product conviction and the founder is very important. Next is the product market fit. What do we mean by product market fit? Can we have a few suggestions or few opinions on what a product market fit is? Chat box is again open, waiting for your reply.
Your question again, Rohit?
What do we understand by a product market fit?
Product market fit.
Yeah, a right product for the right market. Okay. Any other views? Scope for mass sell. Very nice. Scope for mass sell. Product catering to the specific demand. Nice. Where is need in the market or gap in the market? Correct. Beyond pilot stage product. Nice. A product that fits the taste, budget, needs of the customer. Very nice, sir. Very nice. Okay. So thank you everyone for giving your valuable opinion on what product market fit is. So essentially, all of you are correct, right? So when we talk about product market fit, it means a product beyond a pilot stage, which has already achieved a testing of the product through validation of customers, which which fits the taste, budget, and needs of the customer, and which has been a product of a gap in the market, not essentially need, but a gap, right? So when we talk about, I'll take the example of Zepto again, right? There was no need in the market, but yes, there was a gap in the market, especially for working professionals or nuclear families who doesn't have a lot of time to go to the market and purchase daily essentials. So there was a gap. There was no need. Right? So we need to understand the difference between need and gap. So yes, a product market fit is something which is the evidence of need and adoption, whether via user traction, waitlist, or NPS. So NPS essentially stands for Net Promoter Score, which is a well-known parameter to analyze whether that product is acceptable in the market or not, based on the user ratings and the kind of response you get from the market. I hope everyone is enjoying the session. So you can definitely put in your questions in the chat box if you want to ask something in the middle of the presentation. Otherwise, we'll have a good Q&A round at the end of session as well. But yes, if you have any question, you can definitely put it in the chat box and I would like to address it. Thank you. Next, the next point, go to, yeah, correct, thank you. So the next point, we would be talking about the brand credibility. Right? How do we assess the brand credibility when the brand has not yet been formed? For a startup, which is just starting up, can it have a brand credibility? No, right? But then why do we say that brand credibility is one of the most qualitative factors when you're valuing a company?
The promoter and the team itself is the
The
brand
leadership of the
Exactly.
who are the entrepreneurs and founders. Their brand.
Absolutely. Absolutely, Khushbu. And yes, Siva sir, both of you are absolutely correct. So for early stage, there's no brand. The only brand the company is having is the founding team. When a company starts working in the market and they adopt very early customers and they have a good NPS, then we can say that some part of brand is built, but that takes time. So the only brand investors would look at while investing in an early stage company would be the founders and his team. Next point is defensibility. You know, why do you think that this AI, deep tech, and products with patents grow fast? So
But he can't
that
copy it, so there is copyright. So if you are
absolutely
creating something, creativity is there. Nobody should copy that idea.
right. So most of the time we see that investors are very fussy in investing money in a new kind of companies, right? In a new tech companies. So there was a time in 2018, 19, 20 when a lot of startups got funded, even though they were not scalable because there was a lot of money in the market. But now the scenario has changed, right? So even the investors have gone become very smarter after investing for so much of time in the India market, and they now have uh, understanding what defensibility actually means, right? So defensibility would essentially means that if you are developing a product which has a particular IP or proprietary tech or regulatory barriers, or even high market switch or high switching cost. High switching cost would essentially mean exit barrier, entry barrier, right? So we used to study in organizational behavior or business studies while we were in school, that a business is successful if it has a very good, entry barrier. So if you're working in a monopolistic market, say, even for in today's scenario, we have only two telecom operators mostly, right? It's Airtel and Jio. Vodafone Idea is not doing very well. So it's a duopoly kind of market. People can't enter telecom market because it's a high capital intensive, kind of business. Or say quick commerce. A lot of people have come in quick commerce and tried. So one of the companies was Tiny Owl, which started in 2015, eventually got shut down in 2018 when Swiggy took it off, right? So when Tiny Owl has already left $50 million from the market, focusing on quick deliveries. Swiggy was still starting, but eventually in a couple of years, Swiggy took over, Tiny Owl, and it outgrowed Tiny Owl, and Tiny Owl was shut down, right? So when you have a proprietary tech, a regular, high switching cost for any startups to enter in the market, investors like it, believe me. So yeah. Next slide, please, Vijay. Okay. So there could be other qualitative factors as well. There's no end to it, but yes, those five were the most common factors, sort of. And now we'll talk about the quantitative factors, which are essentially the numbers, right? So when we talk about quantitative factors, it's essentially the numbers the company is making. So one would be the kind of revenue a company is making. So whether the business is generating a recurring revenue, whether the business is in the business of generating one-time revenues or one-time product or one-time service, or whether the product is going to add a long-term value to a consumer's life cycle, right? So there could be multiple kinds of revenue. So the kind of revenue the company would be making is determines the valuation to much larger extent. For example, if we are in our business of generating recurring revenue, say a subscription fees kind of thing, which essentially would be running in every month. So there will never be a cash flow issue, right? If you have running revenues or recurring revenues, the cash flow will always be there, right? So cash will be in, cash will be out, cash will be in, cash will be out, and the business will go on and have higher chances of scaling the scalability. Next is the high margin or potential for long-term profitability. So when we talk about margins, high margins, it essentially means operating margin, and operating margin is not the net margin, right? Because when you're starting up, essentially you will have high operating margins, but less net margins, because you have to burn a lot, you have to spend a lot on making a brand in the market, so that people get to know it, right? Because how people get to know it, a new product, through marketing. So the role of marketing is not only to market a product, but to educate customer about a new product as well, right? So high margins, would equalize potential for long-term profitability. Then the next point is how efficiently the capital is used. Does the company have a decent runway to run the business? Now the company would have runway in two ways, right? Wherein the company has already started the business with founders fund or entrepreneurs fund, and have generated certain amount of cash in the business, which supports him for the next 6 to 12 months to run the business. Number one. Next, if you are raising money at idea stage, or at early stage, or at pre-revenue stage, right? This runway will not come into picture, but yes, they would like to see that. Say suppose if we fund you $1 million upfront, and you have to build everything from scratch, how well are you going to utilize it? So the fund utilization becomes very important to the investor from the founder, because that will ultimately show the founder's conviction towards building the business, the founder's what you say ability to utilize the funds in a much better way. Next is the strong LTV or CAC ratio. So LTV essentially would mean lifetime value of the customers. That means how much a particular customer is going to pay you over its lifetime. So suppose I become the customer of, say, Bangalore Valuer Association by paying a certain amount of fees, say 2,000 rupees annually. So my lifetime value would be how much fees am I going to pay during a lifetime, during my lifetime. So that will become my lifetime value. And how it is computed, it's a different topic altogether. But yes, every industry have a different set of multiple, right, which determines the LTV in a particular industry. As for example, in SaaS industry, in software as a service industry, or mostly in fintechs, the LTV ratio is around 10 times of, it's around 6 times of how much the subscription fee is. Suppose the annual subscription fee is $1,000, so lifetime value would be close to around $6,000, right? CAC would essentially means the customer acquisition cost. That means the cost you're incurring through marketing, promotions, or maybe hiring the salesperson in getting the customer on board, right? So suppose a customer is going to pay $1,000 for a subscription, and you have 100 customers against which you have spent $10,000, so the customer acquisition cost would land up to $1,000. So essentially, you will see that the marketing, the sales cost, and all everything is fixed for a certain period of time when you're starting up. So more the customers, right? The lower will be your customer acquisition cost. So in startup terms, in startup, we say that if your LTV is 3x of your CAC, if your LTV is 3x of your CAC, that means your customer economics are scalable, right?
Can you explain this strong LTV divided by CAC ratio?
Hmm.
Well,
Correct. So
yes.
see, Khushbu, as I said, LTV is a parameter, right? Or it's a statistical parameter which defines the lifetime value of a customer. When we talk about lifetime value, it essentially means that how much revenue you're going to make over the lifetime of a customer, right? So for that, say you define, or you understand from the customer that what is the goal of the customer when he's purchasing a product, and for how much time. So the time period cannot be defined as such, but yes, there are certain statistical parameter which has been put in multiple industries which determines the LTV. And CAC, obviously, we know that, suppose you're running a campaign, you're hiring a sales team, you're, spending a lot on the.
CAC is customer acquisition cost, I think.
Correct. CAC is customer acquisition
Okay.
cost.
Okay.
Okay. Thank you. Thank you, Kushbu. Next, we have contribution margin for customer or payback period, right? So again, when you are a early stage startup, the contribution margin per customer would not matter a lot. But when you scale your business to a certain extent, right, contribution margin per customer will become a very, very, very major criteria in ascertaining your acceptability in the market. Because if you are not profitable at customer level, you will never be profitable at a company level, right? So contribution margin per customer and payback period. So payback period was essentially mean time taken by you to recover your customer acquisition cost. So if you spent, say, $450 on a customer, and the customer is giving you, $1,000 of annual revenue, so your payback period is essentially is 2.5 years, right? So which is pretty decent. So long-term customer contracts have good values. Lower payback would demand, would obviously get you a higher valuation. If your contribution margins are higher, again, that will, add up to the valuation as well. So any queries till now, or shall we move ahead?
Move ahead.
Okay. Thank you. Thank you, Kush. Okay. Vijay, can you please move on to the next slide? Vijaya?
Sir, I'm unable to move, so 1 second.
Okay.
Go. 1 second, sir. I will stop my screen and again I will share.
Sure.
No, it is not moving, sir.
Not moving.
Is I don't know. Easier you close it, then again open it. Okay. Yeah. Let me try. So we can discuss now. So the key drivers, as you say, you are explaining the things. As we do normal
valuation for a company, whether we are doing for startups or any company which is in growth stage or mature stage. So in that, what would be the factor? It is depends upon the sector or which things it depends upon.
So see, essentially, as a valuer, when we are valuing a company, right, it's mostly on the quantitative factors. And we do consider some amount of, market trends or, research reports as well. We refer to some research reports as well sometimes. But it's mostly based on the numbers, right? But when you're when you're seeing it from the investor's point of view, the investor doesn't only look at the quantitative factors,
So
right?
investor will come in the case of startups only.
Hmm.
I'm talking not about startups, other companies.
See, this is the things we are talking about. It's key drivers in valuation for fundraising. So
Okay.
I've structured this presentation in that way itself. But yes, I would try to take up your question. As for example, if we uh, say suppose Reliance today has to go to the market and raise funds for his new project, right? So what would the investor would see, or what will a valuer would see?
The brand Reliance has its brand name.
Correct.
That is
Reliance
enough
has a
for it.
brand name.
Yeah.
They have a good promoter history, right?
Yes.
So so these things will automatically come into your mind that the money which I'm putting in, right, whether it will go in the correct hands.
Obviously. Yes.
Correct. So it might not be, there when you're valuing a company through numbers, but it will be in the back of the mind of the investor. And that is why when you're valuing the company, you mention about founder's profile, the promoter's profile, the industry they're working in, the current trends in the market, all those things as a part of your valuer report as well, right? Please just correct me if I'm wrong. I'm not a registered valuer, but I don't prepare a lot of valuation report. But
No, no, you are correct. You can continue. No issue.
yeah. So thank you, Kushbu, for such questions, and hope to have such more discussions in coming session.
Rohit, one question. There
Yeah,
could be various forms of fundraising. Suppose, a long-term debt or
correct.
could be, debt. So the people who provide debt, they are also providing funds. So
Right.
what are the kind of, factors they would like to look in? Are they similar or there are some additional factors or some
Yes,
different
they are
factors?
similar. They are similar. So when you are raising a debt, right? So they will essentially look more into the quantitative factors than the other factors. So when you are when a bank or a institution is giving debt, they want to see whether the company would be able to service the debt, right? That they will be able to pay the interest on time. They should be able to repay back the principal on time.
Yes.
So yes, that becomes a different ball game, right? When you're raising a debt, but essentially the factors remains the same, right? So they will have a priority of first quantitative, then they will have qualitative, then they will have market, and then they will at point they have market, uh, other drivers. I hope I have been able to explain, Mr. Devasish.
Yeah, yeah, yeah. Quite
Thank you.
clear. Quite
Thank you very much. So moving ahead, the next talking about the next drivers. It's the market-based drivers. So when we talk about market-based drivers, it essentially means that what is there in the market for the product or service you're offering. How big is the market? Whether the market is in acceptable mode or reject mode. What are the comparisons? Are there any competitors in the market? Has there been a lot of entry or exit in the market? And what is the exit potential of the startup? Whether the startup essentially is going to make money through potential acquisition or through potential IPO, right? So let's talk about these 4 points one by one. First would be the TAM, SAM, or SOM. It's a terminology which we use a lot in the startup world, right? So TAM essentially stands for total addressable market. SAM would mean serviceable market, and SOM would mean obtainable market. So essentially, TAM means the total number of the total population in a particular sector versus the price you're going to charge. It's the total addressable market. Total serviceable market would mean how much of that population can be serviced through a tech-based platform, say, or the service you're providing. So SAM would be a subset of TAM. And again, obtainable market would be basically how much market can you capture in a particular time period. So again, SOM will become a subset of SAM. So TAM, SAM, and SOM, that's how it will work out. Next is the market trends. I think all of you must be aware that nowadays the investors are crazy about deep tech and AI startups. Why? Are there not good startups in other fields like edtech or manufacturing or even fintechs? Yes, they are. But as you say, right, as we say, right, there's a time for everything,
They are the future.
right? So there could be, a future potential for that product. So there was a time when people were investing a lot in the logistics sector, and that's how Ola, Rapido, and all these startups grew. But in today's world, if you start up with another company which is offering, riding services or cab services, you probably are not going to get funded. But if you start something mentioning AI, climate tech, ESG, right, you have higher chances of getting a good, funding from the investors, because most of the investors have changed their philosophy from, doing a lot of things to becoming specific sector focused funds, right? I'm not saying that there's no scope for other funds, other kind of startups to raise funds, but yes, there are market trends which, makes the investors active in a particular sector rather than getting, invested in a lot of sectors. Next is the comparables. So again, you're starting a startup and you have only one player in the market, right? And you want to kill that monopoly. There's no entry barrier, but you need a lot of courage to start that startup. So if there are lesser comparables in the market, the valuation always tends to higher, because there's no company in this world who can service the entire market all alone. So you need multiple players in the market, and investors love it. Investors love to create competition. So it also happens a lot of time that, say, uh, I have invested certain amount of money in a particular startup which is operating solely in that field, and there's another competing investors, another investor in the market who wants to get into that particular, market, and he finds and he spots another startup who is starting up the field. So then he will give reference to the startup invested by me as a comparable and try to assign a particular valuation to it. So yes, comparables. How comparable your startup is, whether it's unique, whether it would do better than the existing players in the market, right? So comparable will essentially be used to benchmark a particular product or service which is already available in the market. And last but not the least, for the market-based drivers is the exit potential. Investors put money in your company not to burn it, but they want to make a lot of money out of it. So exit potential is something which every investors would look at, even if they're spending or coming at a very early stage. If you don't have exit potential, none of the investors is going to put money. It's not about time, but it's about the potential. So you may say that 10 years from now, once I start, and 10 years from now, my company is going to be potentially acquired by a larger player in the market. or I'll come up with my own IPO. But you need to have a clear plan for the next 5 to 10 years that how are you going to achieve it. So exit potential backed by a theory and a go-to-market plan is something which investors love to demonstrate or get demonstrated from the founders. So
Here, in the comparable point, what are
Mhm.
the similar startups valued? If it is good startup or some coming up something new, so we won't find any comparable startup with that.
Correct. Correct. So if you're starting something new, right? So there
Hmm.
won't be any comparable. You're correct. In that case, the investors assess it with the help of the market trends through primary and secondary research, right? So they might run a research for a say suppose if you're bringing something in the robotics, right? So they might go to larger companies who are generating robotic product or uh, a similar kind of industries who are generating that kind of product. They would do a primary and secondary research by understanding how this industry is going to develop, and on the basis of that you know they arrive at a particular reasoning or valuation, right?
Okay. Thank you.
Yeah. uh, Next slide please, Vijaya.
I have a question, Rohit.
Yeah.
Morning, Senthil here. So, see, do you look at the disruptors in the market, like potential disruptors for a particular technology? Like we value a lot of new startups. They come up with new technology. Like something cheaper can come up. Like most of the failures is like some other cheaper product comes up or some other alternative comes up. So, like investors, do they assess kind of how do they assess the disruptors?
Correct. So it's a very good question, Ms. Senthil. So I'll tell you when it happens, when you are creating something disruptive or you enter a market, established market, and you disrupt the entire market, right? So that again becomes on a combination of serviceable market and market trends. So you got into a market which is already flourishing and start capturing the obtainable market which was already running. As for example, when Jio entered the market was flooded with a lot of, telecom operators, right? So there were Airtel, there were Aircel, there was Reliance Communication, then there was Idea, and Vodafone and Idea were doing, absolutely great. They were just, enjoying the duopoly in the market by charging higher prices to the customers. All of a sudden, Jio enters the market and starts offering everything for free. So that time, uh, the 5G spectrum came into it. So yes, market trend, a new thing came up in the market, a new technology came in the market, which was recently auctioned in the market. And the total market of telecom or the total usage in which the Geo was targeting data was growing, right? So it depends on a combination of, the total, obtainable market and market trends.
Friends.
Yeah.
Yeah.
Thank you.
Thank you.
Very much. Next, we have discussed qualitative, we have discussed quantitative, we have discussed, market trends. What else is left? We have discussed everything, right? We have discussed the founder, we have discussed about the market, we have discussed about the exit potential. What is left? So the next is the future potential drivers. So we have 5 pointers here. So when we talk about future potential driver, it means the scalability, how far a startup or a company is going to scale. Where can it grow 5x, 10x before proportional increase in cost? Can it grow? Maybe not. Maybe yes. But this is something which founders try to address when you're talking to investors. Contracts and partnerships. Are you holding large value contracts in the first year of operations, which would continue for the next 10 years? Have you signed any MOUs which would give you recurring revenue in future? Have you signed any clients which are going to give you, potentially heavier revenue than any other of your competitors? The geographic segment. Are you going to enter new markets apart from India or the country you're operating into? Are you going to launch any other verticals, right? These are the future potential drivers or the future potential questions which determines your valuation. If your company can grow 5 to 10x without proportional increase in cost, right? Don't you think it's going to add both to the top line and bottom line? Right? So obviously, if an investor or potential investor sees that a scalability is high, the valuation definitely will be a forward valuation, right? They will value a company not on your current value, but on a forward looking value. Say they value a company on a 5-year forward scalability model, those kind of things. Next, if you are very sure or if you know that a product is going to scale to multiple market, right? Obviously, it will have a higher, growth or higher chances of getting scaled, because if you're working in one market, you're getting 100 clients. But if you're working in 5 markets, you potentially get 150, 200 clients, right? So the scalability again depends a lot on your geographic or segment expansion. Then yes, contracts or partnerships, you have large value contracts, you're going to make more revenue. And if you're going to make more revenue, you're going to make more profit. More profit would demand high valuations. Product roadmap. So if you're a product driven company, right? Introduction of new products or new features in the product, right? In future would definitely attract new customers, would increase your customer base, make your customers more loyal if your product providing you new features. And if you're providing new features, you're definitely going to charge more to the customers, right? Again, increasing revenue, increasing profit, increasing valuation. And yes, last but not least, which we always talk about as valuers, path to profitability. Whether even after doing all these things, will you be able to make profit? That's the biggest question an investor would ask the founder, that you might continue to burn for the next 2.5, 3 years, but are you going to make profit after that? What is the path to profitability? So these are the future potential drivers which are there in the mind of investors, or they look at it while talking to the founders on potential fundraising opportunity. Next slide, please, Vijay.
Rohit, one
Yeah.
small question. See,
Sure.
all these drivers, they are all, to some extent, they are qualitative. So how the investor would put values to this? Is he has to finally come to a value.
Correct. So investor doesn't put a value to it. A tangible value cannot be put against these factors, right? But these are something which they see as a driver or to ascertain the market or ascertain the investability of the product.
Okay.
As for example, if you are just starting up with a new idea, right? All the quantitative factors will not be there.
Right.
Right. So how will they ascertain whether the business is, investable or not? It's through these factors.
Okay.
Correct. So for established company, they will always have they have already proved the founder's conviction. They have already proved the product market fit. They've already proved that they have good customers who are paying on a recurring basis. And they've already proved that the customer acquisition cost or LTV is already in place.
Yeah.
So all these qualitative factors have already been proved when a company has grown to a certain level.
Correct.
But when a company is just starting up, right, these are the factors which actually gives value to the investors.
Yeah.
Yeah.
Correct.
Correct. Thank you, sir. Next is something which you guys are more aware than me. So the valuation method used by investors, right? So So those are, there's a basic difference between the valuation done by the investor and valuation done by us, the valuers, right? So essentially, or technically, or practically rather, I would say that investors never look at any kind of model when you're valuing a company at early stage. They only look at the qualitative factors and the founder's profile. But nevertheless, when we talk about venture capital method, is something which doesn't have any kind of calculation. They just put money on the conviction of the founders. They put money on the conviction of the product which is getting launched in the market, because they have nothing, right? So that is what we call a venture capital method, wherein the numbers are just the numbers and they don't really look at numbers. They look at purely qualitative part. Next is scorecard method. So a scorecard method would essentially come when a company is a growing stage, it has grown to a certain level, and you can compare that startup through the industry benchmarks. As for example, when Reliance came into retail, right? So the valuation of Reliance retail would have been determined by the investors based on the other retail players in the market, right? So the scorecard method. Next is discounted cash flow, which most of us uses in our day-to-day life for the companies which have stable forecast, who have stable revenue, and they have a growth story to play in the next 5 to 10 years, and they want to get their company valued at the current scenario, at present. Right? The discounted cash flow method is basically nothing but discounting your future value of cash flows in present. Then comparable multiples. Comparable multiples basically would means they would look at your EBITDA or your revenue, and they've assigned a particular multiple, right, to it to arrive at a value. As for example, if you talk about fintech, right, you generally get a revenue multiple of 3 to 4 times of your revenue, not profit. So then there are trading firms which are new trading business. In trading business, you don't get a multiple on revenue, you get a multiple on the EBITDA or on the profit, right? Because in trading, the margins are low. So you get revenue multiple only on those businesses wherein the operating margin or the contribution margins are higher, wherein you make more money, the cost of selling a product is lower, but the revenue you'll be making is, say, good. As for example, suppose you've developed a product and you're selling it $1,000. However, the cost to make that product is just, $100. So you're making a 90% gross margin. So in those kind of business, you would get a revenue multiple and not a EBITDA multiple. But if you're in a trading business, your cost of selling would be 990 and your revenue will be 1,000. So you will be making only 10 rupees in profit or contribution margin. How can you get a revenue multiple there, right? So there will be profit multiple there. How much profit are you able to make in the market in that particular field? So that depends from industry to industry, company to company as well. So, but yes, in a general term, higher the contribution or gross margin, higher will be revenue multiple, and lower will be the gross margin, you'll get a comparable multiple at EBITDA level. Next slide. Any queries here? Okay, so we can move ahead. You talk about qualitative factors, quantitative factors, market drivers, and other investor profiles and valuation techniques. But do we understand at what are the red flags affecting a valuation, or even affecting the decision of the investors to invest in the company? If you have inconsistent financials, if you're not reporting your financials in the correct way, if you're not getting your books audited, or an investor finds that MIS you're sharing on a monthly basis doesn't correspond to the annual report, don't you think the investors would be unhappy about it? Correct. So it gives a very bad message to investors when you have inconsistent financials, that a company is not utilizing the funds in the way it should happen, right? So yes, inconsistent financials are a big red flag for the investors and always lies on the top. Vague use of funds. Investors want clarity on how their capital will be used. If you don't have a clarity, it's a red flag. Why would you put money on you or invest money in you or in your rather in your company if you don't know how to use it? So it's a red flag for the investors. Next is customer revenue concentration. You have 100 customers, but only one particular customer gives you 50%, more than 50% of the revenue. It's a red flag for the investor because if that customer goes, your revenue will be, just 50% of what you're currently making. So it's a high concentration risk. Again, a big red flag. Compliance issues and leadership abstraction. You're not paying your taxes on time. You have IP disputes. You have unclear ESOP plans. And you have people at the top level or leadership level leaving very soon. You must have heard that the CFO and the Chief Human Resource Officer of Zepto recently left just before the IPO, which created a lot of buzz in the securities market. People started writing articles that they have left because of the toxic culture and everything, and a lot of things. And a lot of investors issued a clarification there as well. They wrote a letter to Zepto as well to control the attrition. And post that, Zepto came up with a new HR policy for the employees. So these are all the potential or major red flags which determines whether investor would be interested in investing or valuing the company to its potential. Next slide, please, Vijay. Now, when you're going for a fundraise and you know that what are the factors which determines a valuation, can you improve your story? Or I would say that how can you improve your valuation story? Or how can you convince the investor that you're investable? Your early matrices, your discipline, your tracking of CAC, LTV margins, even before the raising, shows more confidence to the investor that you are well within your working area, you are well within the what you say, discipline, or well within the path to profitability. Next is milestone based planning, breaking of roadmap into fundable stages. So if you have a clear milestone that you need to grow the company in the next 5 years based on say this 5 milestones. So you have milestone 1, you have milestone 2. Say your milestone 1 is to get 100 customers, right? You completed it, you tracked it, and you have shown that you achieved everything on time or with a very limited delay, right? So your valuation story, or rather the founder story, the company story, improves a lot. The third party validations. If you have raised something from angel investors, you have pilot projects running on a particular client, on a couple of clients, which is paid. So that shows that your product is becoming accepted in the market, thereby improving your valuation story. Cap table hygiene. So cap table essentially means the shareholding pattern, the number of shares you issue to multiple investors. Have you been transparent in showing all the investors on the cap table? Whether you have all the shareholder agreements in place, whether you have share subscription agreements in place, whether the capital has actually flown into the bank account after the issuance of shareholder agreement, after signing of shareholder agreements. All these things adds a lot of value in the form of discipline within the company. And yes, data room preparation, keeping all the MIS, all the contracts, all the compliance docs ready to be available to be made available to the investors. So these are basically a few things which every company or founder should do when they're going for a fundraise. They need to be completely prepared and have these things in place if you want your company to raise funds at a good value and at a good faith, or from a very good investors. Next slide, please, Vijay. Okay, so these are some interesting case studies which I've gathered, right? So these are a mixture of qualitative and market trends and quantitative factors as well. So let's just go through it one by one, and then we'll have a round of session for questions and answers. IntelliBot. So I don't know how many of you know, but IntelliBot was a AI-based SaaS solution which raised at a 10x ARR due to high ARR growth, 12-month pipeline, and pilot success with a unicorn client. So what does it say? So they got a 10x revenue multiple. They got a 10x revenue multiple. Why? Because they had a 12-month pipeline. They had clients who are ready to pay for the next 12 months. They did a pilot success with a unicorn client. Unicorn means a company valued at over 8,900 crores. A company which is valued at 8,900 crores, and they are taking a services of a new startups. That gives a lot of confidence to the investors that a product could be used by large companies. And yes, here it is. There is at a 10x ARR. Next, LearnLoop, a edtech company, despite having 1 lakh users, received a down round due to lack of monetization, high churn rate. So they started off with a free learning model, right? So they got a lot of users, but eventually after running for 4-5 years, they were not able to monetize all those users, right? So if you're not able to monetize your users, you're not going to make any revenue. And if you're not going to make your revenue, your valuation is not going to increase. Right? And ShipX, it's a B2B logistics company which was pre-revenue but raised $6 million. They raised at a $6 million valuation based on exclusive long-term contracts signed with 3 national brands. So again, a fundraise pre-revenue based on the founder's profile and their long-term contract. MindNest, a health tech company working in the mental wellness space, received a higher than expected valuation after the Calm and Headspace merger triggered investor optimism around across the sector. It became all of a sudden, you must be knowing that the mental wellness space become hot topic. For the past 2 to 3 years, there have been a lot of companies which are focusing on mental health. Mental health has become a lot of issues in US, they have become a lot of issues in Japan, and now in India, right? So mental wellness startups have come up and they've started getting good funds. Because why? Everyone is going in that direction. Next, we have Bella Naturals, a D2C brand, a beauty brand, which showed a steady CAC decline over 6 months and broke even on ad spend, leading to a valuation markup during its pre-series A. So they continuously reduce their CAC. Obviously, if you're reducing your CAC, your relative is going to increase, your revenue is going to increase, your cost is going to be low, and thereby you're heading to the bottom line. So these are 5 classic example of what we discussed. It includes both every kind of thing. It includes qualitative factors, it includes quantitative factors, it includes more market trends, and it includes other exit potentials as well. So these are a few yeah.
Rohit, can you just tell us what is the D2C and what is CAC?
So D2C is direct to consumer. So suppose if you are selling something directly to the retail consumers, as for example a beauty brand, say the Vinita Singh's company, right? Sugar Cosmetics, a D2C brand, right? So they're selling lipsticks and all those cosmetic products directly to the consumers through retail outlets. So that's a D2C brand. Boat is a D2C brand, right? So any consumer product which is sold directly to the customers. And CAC is customer acquisition cost. So essentially what happens technically that when you are in a D2C business, you need to spend a lot on the marketing in the initial stage to attract customers and to educate the customer that you are a new brand which has come into the market and you want to sell your product. So at that point of time, the marketing cost is very high and the customers are very low. But as you scale and your customer grows with your same kind of marketing spend, then the customer acquisition cost gets reduced, right? Because if you have customer acquisition cost is essentially nothing but total marketing spends divided by the customers acquired. So if your customers are more, your denominator is higher, your result will ultimately be lower as well. So this is what they did. So they launched, they scaled, and then they essentially or technically they reduced their CAC over 6 months continuously. That means they were continuously adding more customers in their kitty. So that actually led to a higher valuation. Am I clear, Kushbu?
Yes.
Yeah. So I think we are done now. I think we have one more slide. Next slide, please, Vijay. Yeah. So I think what we tried to understand from the whole topic is valuation is influenced by a mix of team, traction, and total.
Team here, what do you mean? Like mix of team means what would be that?
Mix of team would mean the founder
Okay.
and its founding team, the employees they're hiring, So if you have a good team, right? As for example, say you're running a company and you've hired the best person from the market. So if you hire the best, right, and your team profile is good, it gives a lot of
When we do valuation, we don't ask for team. We just ask for the like if we are valuing the startups, we get their pitch deck and who are the founders or
correct.
the whole team. Yeah.
So generally what happens when you're going for a fundraising, right? They
Hmm.
specifically ask for the team profile or the leadership profiles on the pitch deck,
Yes.
right? So that is what that is why we say that founders and the team is very important because they will be the ones who will be executing the idea. So if they are strong, they are knowledgeable, the business is going to grow.
Or what about the traction?
So traction means the quantitative factors that your number of customers, how your customers are growing, the markets you're working into, what is the revenue you're making. So traction would essentially means the KPIs you're tracking.
Okay.
Yeah. So valuation is influenced by a mix of team, traction, and total addressable opportunity, as we discussed. You need to build a strong foundation and tell a clear data-backed growth story. And remember, you don't get the valuation you want, you get the one you can justify, right? So you don't, if you want that, you want to have a valuation of $10 million at a revenue of $10,000, that's not possible, right? So you will get only those valuation which you can justify. So if you can justify a $10 million valuation at a revenue of $10,000, you can get it. But even if you're not able to, justify a valuation of $10 million at a revenue of $10 million, you might not get that as well, right? So it all depends on how you justify your valuation based on the multiple factors we discussed. So I think from presentation point of view, I'm done, and I'll open the forum for a few more questions or any discussion you would want to have amongst ourselves. And thank you once again for giving me an opportunity to explain this topic or rather discuss this topic with you. Thank you.
So Rohit, I have one question. We were like talking about D2C and CAC, right? So what about platforms like Nika and all? They are not like it is not called as a D2C, is it?
So it's a D2C business, but
That is also a D2C business.
Nika is primarily operating out of e-commerce platform. And very recently, I mean, from the last couple of years only, once they went public, they started having retail stores in the malls as well, right? So they are now they are also a D2C plus e-commerce brand.
Okay, so okay. Previously, it was only an e-commerce, and
E-commerce
now
brand,
it is.
correct.
And of course, we also have to, when we look into their financial statements, we'll actually be able to make out what is the revenue that they are earning from e-commerce and what is the revenue from
Correct. So
the
they
retail outlets.
segmented they segmented their, growth. So
Mhm.
first of all, they were present only in one segment, only in commerce. Then they pivoted into D2C as well. Post listing, I think, as far as I remember, post listing they went into D2C.
Okay.
Yeah. So if no one has any question, we can uh, end the presentation here. Neeraj, you're there?
Rohit, I wanted to
Yeah.
ask a question.
Definitely.
For D2C customers, usually CAC is a uh, measure to understand how much they are spending to acquire the customers. But if it's a case of B2B, okay, then
Hmm.
what is the alternative to measure the advertisement cost or the cost of acquisition of the clients? What would that be like?
So essentially in B2P, you need to hire a lot of sales people, right?
Hmm.
When you're working in a D2C business, you don't need a lot of salespeople. So in B2B, what we have seen that the customer acquisition cost comprises of a lot of, salesperson's cost as well,
Okay.
which would not be there in a typical D2C business.
Okay.
So you don't need a lot of salespeople to reach to the masses. It's mostly through advertising campaigns,
Yeah.
right? So technically the, cost of sales team or, cost of sales softwares or, other sales costs like promotions or events, they get added to a B2B, customer
Okay.
acquisition cost. Yeah.
Okay. Thank you, Rohit.
Thank you, Jivika. Any other questions, guys?
Yeah, Rohit, tell me about you, na? Like what you do and all.
Yes. So, Khushbu, I am a chartered accountant by education and I've been into corporate for 12, 13 years. Last position was head of finance in a couple of startups.
Okay.
And my role in those startups were to scale the company to multiple markets and raise funds from investors so that we can scale more. Now I run a advisory firm called Ashwasan Advisor, which is a startup focused advisory firm wherein we offer fundraising services to growth stage startup, whether it's debt or equity. We help them in, structuring the deals in a cross-border environment. And we also offer virtual CFO services wherein we help smaller startups to gain expert insights from our experience.
You're
So
based in Kolkata, Bangalore.
we are based out of Kolkata and we have a branch office in Bangalore. We have recently started a branch office in Bangalore and we are expanding to Middle East as well in the coming 2 to 3 months. We should be have a presence in Middle East as well.
So what is your team size, if I can ask?
We are 6 people at present. We are 4 partners and 2 employees. And
Okay.
we most of the I mean, all of us work mostly remotely. But yes, we travel a lot to,
Hmm.
meet people, to meet,
So when you, as you are catering to the startups only, you must be involved in the valuation process and all.
So we are not dealing only with startups. We are dealing with growth stage companies as well. We are a startup focused, firm, but it's not that we are only dealing with startups. And yes, we are involved in a lot of, valuation thing, investor relations, investors, question sessions, right? So most of the companies we
Yes.
raise funds for, right? We deal with the investors in,
Yeah, you also talk with many kind of valuers, like
yes,
what they are doing, or how they are doing the valuation, so that you have that
right.
practical insight with you.
Right, right, correct. And when we are dealing with valuers, so they will
Hmm.
essentially most of the time, 90% of the valuers will look only at the quantitative factors or numbers because that is what they are concerned about. But when we talk to the investors about the valuation of the company, They will first talk about, founder's profile, founder's team, and then they will get into the numbers, right? So there's a different approach which is being followed by investors.
Depends upon the sector also, in which sector the startup is coming with.
That is also
Really.
there. That is also
Hmm.
there. Yes, that is also there.
Sometimes it happens ki the founding team is not that expert in that particular field in which they are coming up. Like I was doing a valuation of one online gaming company. It
Hmm.
was a kind of short view into cricket only, like Dream 11 is doing. So it was doing. I have seen like many startups are coming up with this cricket thing.
Hmm.
So that company I have seen when I checked their profile of founders, they were not into this thing, but they have started this. They have designed this app, so they are coming. So in that, I was finding it very difficult. They don't have this backup of a good founding team. They don't have the expertise also.
So just one question, Khushbu.
Yes.
So suppose if I'm not a chartered accountant,
Hmm.
would people consider me as an expert of audit?
No.
No. Suppose, so that is the thing with founder's profile as well.
Hmm.
So if you are not from a similar kind of field, if you are not from, if you don't have the subject matter expertise in the field you're starting up, you might succeed in short term, but
बट क्लाइंट्स का क्या होता है ना, क्लाइंट्स आर वेरी पर्टिकुलर कि हम लोगों ने स्टडी किया है मैम, हम लोग पूरा देख के आए, वी हैव सीन, वी हैव डन द मार्केट रिसर्च एंड देयर आई टोल्ड देम देयर आर 70 एप्स इन द मार्केट, more than 70 registered or 70 apps into this cricket. You might come, but how you are, it is like, it is red ocean, it's not a blue ocean. You can see there
correct.
are multiple Dream 11 or My Circle 11. They are from 22 years in the market.
माई सर्कल भी खत्म हो गया, माई सर्कल भी कहाँ है अब?
ठीक है, but they are still they had made their money. Now
Correct.
you want to enter, you are not getting it something very different. You are giving the same thing. So
देखो
ये problem आती है when we do this kind of startups.
आती है, बिल्कुल आती है. And if you look at Dream 11 as well, right?
Hmm.
So even Dream 11 is giving you a lot of innovative options when you're betting on the app, which no other platform is giving.
That's
Right.
why people are going, or the
That's why
people
people are
from
going.
lower strata, they mostly use Dream 11. Me, I don't use, or like my friends, they won't bet for even 500, but people are betting for that. It's a betting platform. It is, they are saying it is skill of chance, but
Correct.
it's not. We know what it is.
And when we talk about founder profile, na Khushbu, one thing also we need to understand whether it's not only about experience in the particular fields, because a lot of, you must have seen that when Bhavesh Agarwal started at
Hmm.
Ola, he started right out of college.
Hmm.
He didn't have any kind of experience, right? So how did he
But
got?
he know the gap, or he has
Correct.
some
He
kind of
identified
vision,
the
or
gap. He
that
was
he
the
had.
first
Yeah.
mover. Correct. So he was the first mover. So he got the
Yes.
first mover advantage.
Yes.
So in startup world, we say that if you're starting first, then probably you would only be the one who would be ending it.
Yes, if there
Right.
is a loophole only, you will only identify in some years. That Bhavesh
Correct.
Agarwal, he has done it very good.
Right. Like Dipinder Goyal, he identified
Hmm.
a gap in the food delivery.
It
So
was there. It was there. Though
right.
Zomato is not performing very good, or
What
losses.
experience did Dipinder had in food delivery? Nothing, right? He started right
Nothing,
from
nothing.
college, right?
But he has
So,
a good background. He's from IIT.
exactly. So that is why we say
Education matter, na.
education matters. So
He had done his market study.
so I don't know about what he did at his time, but yes, what I've understood from Dipinder's a couple of interviews that uh, this was a gap which he found when he was traveling to different countries as well, wherein he
Okay.
saw that food delivery was done through different companies and the food was being sold by different companies, right? So that was the gap he identified in the company and started Zomato. Right. So
Then Swiggy
there are a lot
followed
of
him, but
examples.
yeah,
Like for example,
he did the same thing. Yeah.
correct. Zip Electric, right? So they launched electric scooters specifically for delivery person. So a lot of people didn't back him, but when they came into Shark Tank, a lot of, all the five sharks told him that you're not going to scale. It's not a, scalable option or something. But right after Shark Tank, they got an investor who put in for $40 million in their company. And now today, all the delivery partner uses Zip Electric, at least in Bengaluru. Right. So it depends. I mean, the kind of innovation you bring, it's a very subjective thing, right? It cannot be measured only through a defined set of rules or defined set of questions or defined.
For startups also, they don't be frustrated with or anyone what is saying. Like they were not having very good response with the Shark Tank, but they
Correct.
continued because they know what they are doing.
Correct. So again, it's a founder's conviction, right? A founder,
Yes.
you can't say a founder how to run a company. So even after
Sure.
the investor has invested in the company, an investor cannot come and say, a founder, that you should run company as per my will.
Mm-hmm.
Because if you're telling this to a founder, then you're never going to succeed. Right. So I've seen many investors getting into the integrities of, telling
How they work. Yeah.
of how they work.
Micromanagement. Yeah.
And I've seen 90% of those companies failing. If you're micromanaging a company, it's not going to work.
Yeah, Shilpa ma'am.
Yeah, Rohit, actually, the statement what you made just now,
Mhm.
ki, even Shark Tank, who was so experienced, will not be able to tell whether it is it depends upon many factors. So, as
Correct.
a valuer, what happens to me is I will not know whether any company can achieve 100 crore, cannot achieve 100 crore. Say, for example, Shark Tank, if I had the same view, I'm a valuer, but then I had the same views what Shark Tank had, then how comfortable am I to give the same valuation, like how the new investor gave in? So as a valuer, I'm always in a fix. If I'm giving low valuation, sometimes it pricks my heart that, maybe this company has more potential, but my own conviction, I'm just pulling them down. Or if it's more that, whether some statutory authority, because, okay, good that these people, Zip Electric got good funding, but suppose someone was actually coming, maybe it would have had a dead end. So, imagining a statutory authority will question me. So, can you give me some five, six very great points wherein someone is questioning me, Shilpa, your valuation was great. So, how can I face a statutory authority when I am accused of higher valuation? Lower valuation, nowhere is bothered. Higher valuation only, I'm worried.
See, basically, technically, whatever valuation we do as a valuer, it's based on a lot of assumptions, right?
Agreed.
Right. So if your assumptions are not fulfilled, the valuation is not achieved. Number one. Next is, not all startups succeed, Shilpa. Right. It's a hard truth.
Yes, yes,
Right.
yes.
Even if you say, suppose today you can, say, value a well-established company at a very higher valuation, but tomorrow one fraud or one mishap happening in the company, and the entire company will be gone. Right. There, all your valuation calculation will not be of any use. Right. So technically, what I feel is, uh, valuation is subjected to a lot of, permutations, combinations, and assumptions which a valuer makes at the time of deriving at a particular valuation in discussion with the founders and market research. And next, valuation cannot be considered as the only parameter to show that a company is definitely going to grow or definitely not going to perform. So this is all I can say, Shilpa, at this point of time.
Yeah, yeah. But this conversation was very enriching, the example what you told, so that, we can gain some points, keep the standard, answers ready in case anyone
Oh,
questions our
that is
valuation.
that is the whole point, Shilpa. I try to make conversation a little interactive so that no one gets bored, especially at this time of the day. And neither just taken this very seriously. Early to bed, early to rise makes a man healthy, wealthy, and wise. Right. Making a seminar at 7:30
It's
in the
very
morning.
good actually from discussions. We all are valuers. We are doing the valuation, but sometimes it happens we are doing the valuation, we're giving the report, but we are very apprehensive or we are skeptical about what will happen if like Silpa ma'am also asked, if the statutory authority asks for something. We are
See, I'll tell you
we are
one more
giving
thing.
the on assumptions.
Correct. So I'll tell you one more thing.
Yeah.
I don't do valuations. I mean, I'm not a valuer, so I don't do valuation, but I do a lot of discussion, or I meet a lot of founders and investors on a daily basis. And we try to understand the market in very depth, right? Because when we are meeting the investors and we are pitching about some founders, uh, we should have a lot of, data or knowledge about the what founder is doing, or how the industry is performing. And investors want to listen the whole story from the founder itself. They want to understand कि उनका background, what is their background, how they are going to launch a product in the market, how they are going to raise funds, or how they are going to utilize, right? And if they're asking these questions, that means that it will have some weightage on the valuation. Investors have specifically told us, that if the founder is good, if he knows how to use the money, or if he knows how to reach out to multiple people, or if the founder is a great salesperson who can sell any kind of product, right? Valuations tend to be higher, no matter what a valuer is giving. It will just be a document for them, right? So investor doesn't really care about the paper valuation. What they think
Mhm.
about is their conviction on the founder, right?
One
So
more thing, when you say how you just go to market strategy of any kind of startup, if they are saying it that we will do with this, but they don't have a backing. They don't have a backing, or they don't have the documents with any party, how they will go to the market, how will do the digital market. They don't have signed any kind of agreement. So how, as a valuer, we should proceed in that kind of assignments?
you should never consider anything if something is not documented, right? So as a registered valuer,
Mm.
we first of all we need to understand that the purpose for which we valuer are doing valuations, right? We are not, you know, we cannot.
Practicality is different, Rohit. As I
Correct.
will not do, I will deny, somebody else will do. So what should be if I have to do it somehow? So what should be the case? Like practical तो ऐसा ही होता है. If I don't do, somebody else will do. They will find somebody else.
What can I say here, Khushbu? I
Like
mean,
with caution, if I want to do,
right.
बहुत कुछ we need to see, and but sometimes it doesn't allow us, or they don't give us the information, or
Hmm.
we are stuck to the assignment that we can't leave it on the middle, you can say, in that kind of situation.
It's difficult to answer this question, Khushbu. I mean,
Okay, no issue, no issue. If
married
somebody
people are
else can
difficult.
say, like, you
Yeah.
all are valuer, yeah. Shilpa ma'am?
Yeah, basically, I will give my experience to it.
Yes,
Okay.
ma'am.
My conversation with the promoter will be, see, somehow you will be able to take up this round. Absolutely no, fine. Somehow I am getting convinced, or whatever you're able to convince someone else, you can tide
Hmm.
over this position. Next round, what happens is that will be a very critical round wherein you need the money.
Hmm.
That time, if you keep on increasing the valuation without increasing the real worth of it, you will reach a point wherein you badly need funds, but then you're already overvalued.
Hmm.
And there comes to an automatic end because you're so overvalued, but you will not get money at that valuation. So this is one case where we tell them, you have to have some realistic expectation from the market, from the valuer. If you can bulldoze everyone one point of time, but not every time.
Yes.
So if there is a fundamental flaw, like you have seen red flags, na, somewhere,
Yes.
so we try to alert them, okay, don't have an over expectation in this round. Next round will be difficult for you.
We are always bound by rules and methods which we should follow, but as we are valuers, we assume something. We have our assumptions.
Yes.
Sometimes it's very difficult to get the assumptions right, or just we do it.
When you make this statement, Kushba, I always wonder,
Yes.
Rules, what they say, IVS 2025, you focus on ESG. ESG in a startup, when I see environmental, actually it is neutral, nothing much. There is no carbon foot.
Yes.
And then when we talk about social, definitely these days, like urban cities and all are inclusive in nature, mostly.
Yes.
And then governance. Very less employees will be there. Governance, normally they don't take too much of an interest or too much of special care. But then as a valuer, I'll be still thinking, I have to follow the rule, but what will I say in my report? ESG is important. Rule is saying that, but then what should I mention there? So I'm always in a fix when I have to follow the rules and then the facts are slightly different and how to put it.
So what you do, ma'am, in that kind of situation?
I will, the company specific risk, what I attribute to the company, I add one qualitative parameter this. I use a scorecard method. Then I take all qualitative, quantitative parameters and arrive at a certain alpha that is company specific, considering ESG also among the various other factors.
Okay.
And as valuers, we have to highlight what ESG parameters we have considered on what ESG parameters, like whether the company in their financials have considered or not. These two places, ESG, I specifically ensure I add in my report about the company, what they do, and about me, how I have assessed their risk.
Okay. Thank you, ma'am.
Khushbu and
Yes.
Shilpa, it's a very interesting topic to which Shilpa ma'am has actually brought up. One of the parameters would be, the ESG parameters, right? How much carbon
Yes.
footprints you're generating and how you are going to make an impact, right? So there will be again a lot of, industry specific parameters which needs to be looked into when you're valuing a company. If you're, doing something for a manufacturing company, which is already say, established kind of company, say particularly in iron steel. So you will have an industry outlook, you will have everything, right? But when you deep dive into the company's policies towards the emerging technologies like ESG, or how they are, you know, making environmental safe through the production. So those kind of things, qualitative things also impacts a lot, when you are valuing a company. So if you are, say, why does it matter? Because if you are a company who is, getting the ESG audit done, who is, doing a lot for the environment, who is doing a lot for the sustainability, the long-term prospect or long-term growth of the company, long-term acceptability of the company in the market will be higher. But if you are a non-compliant company, right, someday or the other, the environmental committee will come and shut your business.
Yes.
So
There's always a risk.
So doesn't matter whether your company is worth 100 crores or 1 lakh crores. If your company is shut down, you're worth nothing.
Yes, completely agree.
So that's how these qualitative factors actually impacts and override the quantitative factors in long term, right? So, I mean, it depends on industry to industry. Thank you, Shilpa ma'am, for bringing this up. Thank you.
Yes.
So,
Anyone
Rohit,
has
one
any
more,
questions? Yeah.
one more query for you. I think you're well versed with, foreign investors or their expectations, or helping the companies, to have an office in Singapore or something like that, right?
Right.
So what is the expectation if a Singapore, that is ODI actually, but have you seen how the any of your foreign HNIs or the people who are interested to invest, what do they look at? Like sometimes, they have these favorite industries, right? Is AI something which attracts them, or what is it that is presently
It's the
attracting
market
foreign?
trends. See, it's the market trends. I'll tell you. Gone are the days where investors will wait for 10, 12 years to get their return. Nowadays, most of the investors are looking at a very short term, kind of thing. So they want to go with the trend, right? So that is, I would say that, technical analysis in a startup market, right? So when you trade any stock, there are two kind of analysis which you can do: fundamental and technical. Fundamental essentially would mean looking into the company's financials and then making decision, and technical would mean looking into the charts and making decisions, irrespective of how the company is doing. So, so that is what for most of the investors are now looking at the trends, or I would say the pattern in which the market is performing. So if the market is accepting more AI products, so they would like to invest more into AI. If the market is looking more into deep tech, they would like to invest in deep tech. If the market is looking into fintech, they would invest in fintech. So although there are a lot of funds which are sector specific or sector agnostic as well, it depends on the investor's philosophy of how he wants to explore. But yes, mostly most of the investors are running, in the market based on the market trends. So if it's AI which is hot today, you'll get invested in AI very easily.
Actually, sometime back, EV was getting more attraction, but now these days people feel that EV is very risky. You never know when the big shots will come, and then, like,
Correct.
this is what is my feeling. What do you say?
See, you're completely correct. EV, when the EV trend came into picture in 2020 during the time of lockdown, there were a lot of policy which on EV which were developing, and EV was still in the what you say testing phase, right? A lot of people were testing that market. After 3 to 4 years, the market got cluttered, and everyone started doing EV, and it got a lot of. Then people started to realize, that what are the nuances of this particular sector, right? What could be the issue with the battery? What could be the issue with the charging ecosystem and all those things? And again, now a lot of new technologies which are better than EVs coming to picture. So now people have started losing interest in the EV.
Okay, like what? You're talking about alternative energy?
Yeah, alternative energy.
Oh.
Like
Hydrogen maybe?
hydrogen. Correct. Hydrogen is there. Then there's another technology which is coming. I don't know if you've heard. It's a water-based fuel, right?
Hydrogen is that only, I think. No?
No, I think it's a little different. So hydrogen
Okay.
again is
Okay.
uh, something which will need some kind of fuel or some kind of battery setup to run. But
Okay.
this water technology would essentially means putting up some water and and running. It's still in the very tech,
Do you
very.
know any country using or any model is there
So
trial
there's
based?
one company in US which has developed this technology still in the patent stage. I'm not
Okay.
sure whether it has been commercially launched, but as I was reading about it in some article a few days ago. I'll try to share that article if I find it.
Nitin Gadkari is a very big fan of hydrogen cars.
Yeah, yeah, he is.
He's a big fan.
He himself has this hydrogen car with him. Personally, he used that.
And overall, it's not only about EV. Overall, the entire logistics line, earlier they were like a lot of investment, but with the Blue Smart and all saga and everything, overall there is no funding for I think logistics and EV industry. Rohit will be in a better position. He has worked with them also.
There is a company in Kolkata, Snappy. You must
Yeah,
have heard about it.
yes,
Yeah, yeah. Electric.
They are running this EV.
I know. Mayank Bindal.
Ha, he's doing good, I think. No,
He's doing
App
good,
does
but
app doesn't
but
work.
but even after running a fleet of 1,200 cars, they were able to raise only $2.5 million a couple of years ago.
it's a
Which
new company. Yeah.
it's a new company, but they raised funds only after making a product market fit and making 1,000 vehicles ran in the market. Ola raised $10 million when they had only 150 cars in the market. That
Snappy,
Brand.
Snappy
They invested
taking
a
the
lot
risk.
in brand.
now they're doing pretty good, but I'm not sure whether this kind of
They are
investment.
also collaborated with this HPCL for the charging
Yeah,
technology in
that's
all
why
over
the news came through.
Kolkata. But they are doing very good. Like they are coming with the EV segment. You got all the cars EV and good condition of cars also that we usually not find in Kolkata.
Yeah, I
Ola Uber.
personally, I personally feel that this sector is going will go for a toss in the coming years.
Okay.
It will not make money, at least in the next 5 to 10 years.
Rohit, I
Uh,
have another query.
Yeah.
These days, we are seeing that lot of grants and subsidies are given. Long back, say 1 or 2 years back, we used to get that convertible, like capital kind of a thing, convertible capital, that kind of instruments. But these days, we are seeing many grants only coming. Though the money is less, 20 lakh, 30 lakh, 50 lakh, but we are seeing various maybe IITs or IIMs or certain incubation centers or central government or state government or some ministry giving grants. Okay, so you
Hmm.
have come across any of such things, or you have any experience of this?
Yes. So, but Shilpa, what I have seen, after talking with founders and So I work with the accelerator program as well, which
Okay.
gives grants to innovation projects in AI. So what I have understood in this grant market is that grants are generally given for any kind of innovation you're going to make or research and development. So if you are not,
Correct.
and then there will be industry specific grant to promote certain sector, right? As for example, there's a Government of India grant for if you want to do something in agriculture or if you want to do something in defense tech, just to promote that industry, right? To create an awareness, that these are the businesses which can also be done, although they are traditional, right?
Hmm.
It's because the number of farmers are getting reduced day by day. People are taking up education and coming into service sector or going into some alternate businesses, which is killing a lot of interest in the agriculture amongst people. So
Correct. Especially the small category, na? Small,
correct.
small land, farmland.
So now government wants to keep the culture of agriculture alive. So they have started giving grants to people who wants to do something in agriculture or something
For
in.
that matter, as a company secretary, we see a lot of FPOs, producer
Correct.
companies, NABARD giving them grants. Yes, yes, we can see
Correct.
that.
So, but mostly what I've seen that the grants are given for something innovative. If you're doing something or making a product which is going to ease life of a lot of people or going to bring a mass, value or, those kind of things. Generally, grants are for that only. I mean, for innovation, research and development.
Maybe you're saying about the incubation centers.
Yeah,
They also give no grants. Some
yes, they do. But incubation centers are essentially
They are
set,
allocated funds, no? They have allocated funds for different
they've
sectors.
allocated funds. Yeah.
Yes.
But incubation centers are generally set up to help the startups in uh, what you say, getting ready for the market, right? So it's basically a group of mentors or entrepreneurs who just guide you on a particular sector.
IITs have their incubation center, the Atal incubation center. Many are there.
Yes, yes, yes. A lot of incubation center, and most of the incubation
Yes.
center will be set up in the education institute, wherein to promote research and development. Because in India, the culture of research and development is not there
Yes.
like it is in other countries.
So startups need to apply there, no?
Yeah, the startup needs to apply there with the program they want to attend, the product they want to make, the innovation they want to do, and all those details. And then there's an interview process which happens.
It's a good initiative, but there is lack of awareness about this also.
I won't say there's lack of awareness. I think there's pretty much people are pretty much aware about this, but it's just that
Okay.
I think
uh,
Kulbu, it is reverse. People
Okay.
nowadays, people are just incorporating entities and saying then we are startup. Now get a startup loan and like everybody says we are startup.
Everybody is thinking they are startup. They don't know what is the
Yesterday I
meaning
got
or
a call from one
yeah.
entity in Calcutta. So he said I
Okay.
have incorporated a company. So well, whether I will get the startup funding and all. So I told him, what are you doing for trading? Then I said, then have you
You
registered
don't
with
know the
yourself?
essence of startup is innovation,
They said,
something
no,
new.
we have not registered. We are startup.
Hmm.
So I'm saying, okay, but you have incorporated the company just yet now. You don't have any registrations and you're not doing
Hmm.
anything unique. What will you get fund for? But then he said,
Hmm.
no, sir, you're not understanding. We are a startup. Then I told him, just because you're saying you're a startup, you're a startup. Then if you
They
come
are
and say,
under the this yes.
I am Narendra Modi,
Hmm.
so then you become prime minister. So he got offended. Then I explained to him, sir, this is not the way it works. You have to get yourself
People are
registered.
having awareness like it is not correct awareness, you can say.
Yeah.
Is a role कि कोई भी start कर लेगा, anybody starts a company, it will be startup. They are a certain criteria that they are not aware of.
Because the
That
issue is that initial registration without the tax certificate, anybody can apply and get. So that way, that is why what happens, everybody just applies for that registration, get the startup registration, and think that we will now start getting funded.
that they also think they will get the tax exemption also.
Yeah.
So it was a very good session, Rohit.
thank you, thank you,
And
thank you.
on behalf of Bangalore Valuer Association, I convey my vote of thanks to you and all the participants to give a very interactive session. And for you also, this is our coffee for you, and we will courier it to you as well. So thanks for you for giving us the insights about the key drivers. You brought a different perspective to valuation, and thank you very much. Thank you, Rohit.
Thank you, Khushbu, and thank
Thank
you
you.
everyone for being so interactive and bearing with me for last 1.5, 2 hours.
No, it was good. It was good interactive.
Thank you very much.
Thank you,
When you
Rohit. Thank you,
attend
Rohit.
any session and you get something out of it, even one point, it always adds value.
Correct.
I
Same
want to
here.
add one point and say we were
Yeah.
discussing about alternative fuels. I just shared one video in which a stove was invented and it uses only water. I request you to watch that video. It is very innovative. Probably, if it is successful, then we will have no dearth of fuel in our country, or no necessity for fossil fuels in future.
But sir, you know that water fuel was invented originally 75 years ago by a American scientist, which never came into picture.
No.
No.
Please do it. It's an interesting topic to read. Please
Sure.
find something on
Thank
to
you, Shiva sir, for bringing it in. Yeah. You have shared the video where, sir?
In
In the WhatsApp group.
BVA
Okay.
members group and BLOR, BLORE.
Okay, sir. Okay, we'll check.
Actually,
Rohit, before we conclude the meeting, I would also invite you to become part of the BVA community.
Sure.
Okay, because we
Sure.
BVA, we believe in education of valuers, and we are always looking for experts like you to bring in more expertise in the area, which is a bit different from what we generally have in our membership group, because we are all registered valuers, but ultimately all the valuers are looking to provide valuation reports to people who are then going for funding and all. So you are another link to that atmosphere or the ecosphere. So I would invite you for the to join the BVA committee on a full-time basis. BVA membership on a full-time basis.
My pleasure, Neeraj. Would love to do that.
Yeah.
Thank you.
Thank you.
Thank you, Rohit. Thank you.
Thank you, everyone.
Thank you.
Wow. Happy weekend.
Yes.
Vijaya, we can conclude.
Yeah.